So we're looking at the 5 C's of credit lending, a comprehensive framework for evaluating borrowers' creditworthiness and managing financial risks that most bankers, organizations, and lenders uses to be able to evaluate borrowers. So the evaluation framework is the understanding of the core pillars used by financial institutions to make sound lending decisions, which we are looking at today. Pay attention, it will be useful for you as a borrower, it will be useful for you as a lender, it will be useful for you as a banker, it will be useful for you as a student. I want to learn more and also as a researcher. Now, the first of the 5 C's is character. What does character measures? The borrower reputation, integrity, and trustworthiness regarding their financial commitment. That is what character is all about. It measures the credit history, that is the track record of past borrowing and timely repayment. Professional reputation, that is, they look at your business background and industrial standing. Intent to pay, honesty, and more obligations demonstrated through proud behavior. That when you are saying to your lender that I want to borrow so much of money, but you are not telling your lender how you are going to pay it, when you want to pay it, and what practical steps you will take in payment, it speaks a lot to your character. So we'll move on to the next C's, the 5 C's, which has to do with capacity. 2. Capacity. What does capacity measures? The borrower's ability to generate sufficient cash flow to service and repay the debt obligation. So the lender will look at or evaluate you on the basis of capacity. Do you have capacity? What turnover do you generate in the year? Out of the turnover, what percentage goes for operating cost, for the cost of sales, for finance, other finance costs? So out of all this, will you be able to bring out enough money and pay the loan you want to take? So the borrower's ability to generate sufficient cash flow to serve and repay the debt obligations. Predictable revenue streams versus operating expenses. How much comes in as revenue? How much go out as operating expenses? The debt ratio. That is the evaluation of debt to income, DTI, or debt service coverage ratio. The income stability, that is consistency of earnings over economic cycle. How consistent is your earning? Does it come once in a month or it comes in daily? So that matters to the lender as one of the 5 C's of credit lending. So we move on to the next one, which has to do with capital. Capital has to do your network, and it is measures, that is the financial scheme in the game or personal or corporate equity invested into the asset of ventures. That is it your own business? What percentage of your earning, what commitment have you made initially as owner equity? That is the money you put down upfront by the borrowers or funders. Network, the total asset minus total liability, providing a safety net. Risk absorption, that has to demonstrate commitment ability to absorb temporary setback. So a business you are not committed with your money as part owner of the company may not be bothered about repayment of loan. So we move to the next C, which has to do with collateral. That is, in case of default, what do you have in place that you are going to use in repayment? That is, it measures asset or property pledge as a secondary security to back up the loan facility in case of defaults, which has to do with asset valuation, real estate, equipment, inventory, account receivables. It has to do with liquidity, how quickly and easily pledged asset can be converted to cash. Risk mitigation, provide a secondary source of repayment to the lender. So that one too has to be looked at. And the last but not the least, in The 5Cs is the conditions. The conditions that surround the loan. What is the economic climate? So the microeconomic trend, deflation rate, the overall market health affecting the repayment flexibility, feasibility. The industry where you play, what is the industrial outlook, specific sectors dynamic, regulatory changes, and competitive pressure facing the borrower. The loan purpose, how the funds will be deployed, whether for expansion, debt refinancing, or working capital. So these are the conditions that I normally look at in and the 5Cs. So the 5Cs has to do with the framework summary. When you look at it, is you have the Cs, the primary focus, the key metric indicator, the character, borrower integrity and history. So key metric, credit score, references, past behavior. Capacity has to do with ability to generate cash flow, debt to income, DSCR, income stability. Capital has to do with skin in the game, down payment, network on equity. Collateral has to do with asset backing and security, which has to be the key indicators are liquidity, market value, and pledge assets. That is what is the how quickly can the pledged security be converted to cash. Condition, external environmental use, market trends, regulatory suit, loan purposes. So these things are looked at. So what are the questions you have? Let's know in the comment section. Thank you very much for paying attention to what we have to present to you.